Hello everyone! When beginners take part in the stock market, they frequently have doubts about which stocks to invest in. Such doubts can even affect an experienced investor. So today we're understanding small cap and big cap stocks to clear the doubts. Traditionally, market capitalization, determined as the worth of all outstanding shares of a company, has a reverse or contradicting correlation to both risk and income. In general, large cap companies, those with market of $10 billion or more, tend to expand more gradually than mid cap companies. Mid-cap companies are those with a capitalization between $2 and $10 billion, while small-cap companies have between $300 million and $2 billion. These definitions of large-cap and small-cap can vary a bit among the brokerage firms, and the dissecting lines have changed over time. The varying descriptions are completely superficial and only matter for the companies that are on the margin. The definition of a big cap and small cap are mostly acknowledged by their names, which show how critical they are in regard of market capitalization. Big cap stocks, also known as large cap stocks, are shares of companies. Small cap stocks, on the other hand, are shares of a smaller firm. Descriptions like this can be often deceptive because many people come under the presumption that they can only earn money by investing in large cap stocks, and that can't be far from reality, especially these days. If you don't recognize how small cap stocks have turned out to be, you will have missed out on a good investment opportunities. Small cap stocks are considered good investment because of their low evaluation, compatibility to expand into big cap stocks. But the definition of small cap has changed over time. What was viewed as a big cap stock in 1980 is now a small cap stock. Key differences: there is a clear-cut benefit for a large cap in terms of flexibility and research coverage. Large cap provisions have an ardent backing, and there is an abundance of company financials, distinct analysis, and market data accessible for investors to evaluate. In addition, large caps are prone to function with more market productivity, trading at prices that indicate the principal company. Also, they trade at excessive volumes than their smaller cousins. Small cap stocks tend to be more variable and riskier investments. Small cap firms only have less reach to capital and overall not many financial reserves. This makes it complicated for small companies to gain the required financing to fill the void in the cash flow, fund new market expansion pursuits, or take on large capital adventures. This issue can become more critical for small cap companies during lows in the economic cycle. In spite of the added risk of small cap stocks, there are justifications for investing in them. One benefit is that it is simply smaller for a small company to bring out proportionally large growth rates. Sales of $500 can be multiplied easily than the sales of $5 million. Also, since a small, close managerial staff mostly run smaller companies, they can swiftly adjust to changing a market environment they are in. The same reason for why a small boat can turn easier than a large boat. Similarly, large cap stocks are not always perfect. As developed companies, they may put forward hardly any growth possibilities and may not be as flexible to change economic inclination. In fact, many large companies have undergone turbulence and lost support. Scaling up stocks. Before we do anything else, we need to define the term cap, which is short for capitalization. The word in its whole, however, is market capitalization or market cap. This is market's approximation of the total dollars worth of a company's own shares. To get this amount, you need to multiply the cost of one stock and by the number of shares remaining. One thing to keep in mind, nevertheless, is that while this is usual notion of market capitalization, you are in fact supposed to add market value of any company's publicly traded bonds to evaluate the complete market value of a company. The market cap determines the magnitude of the company, something of heed to most investors. That is because it usually points out various basic attributes of a company, including its risk analysis. Even through the value of small cap stocks may vary from dealer to dealer, the usual understanding now is that they have market caps ranging from $300 million to $2 billion. One misinterpretation people will have about small caps is that they are startup companies or just span new establishments and they're breaking out, but this can't be further from the truth. Many small cap companies are just like their bigger equivalents in that they have a well-built track record, are deep-rooted and considerable investments, and because they are smaller, small cap share prices have a bigger possibility of expansion. This implies that they have a much more prospect for investors to gain money quicker. The big boys. Big cap stocks are the biggest publicly traded companies with the market caps of like $10 billion. For example, Green Electric and Walmart. These organizations are known as blue chip stocks. Companies like this come with a record of a reliable income, well-grounded reputation, and strong financials, while companies like this seem to carry out well and yield secured income for investors. You can't use this coverage for all large caps, for investors have the misconception that large cap market comes with a much lesser risk than smaller stocks. Because of their worth, they have various instances in the financial account evidence that point to the contrary. Enron is just one example. It is set out to denote that the larger they are, the deeper they fall. The company, which has the dearest of the energy sector, was a concern of accounting affair. The company used to use the market to market, or MTM, considering to make the company look like it was much more successful than it actually was. The branches were losing money, but the company continued to conceal its losses and debt, using off-balance worksheets and operations to disguise the dead assets. The company's deperformed and ended up bankrupt. The chief workforce, including CEO Jeffrey Skilling and the company's accounting agency, encountered criminal allegations. The moral: just because it is a large cap doesn't mean it is always a great investment. You will still have to do your study, which means look into other smaller firms that can offer you a great ground for your overall investment portfolio. Ranking caps. The description of caps, or large caps, and big caps and small caps, stock vary a bit amidst brokerage companies and have transformed over time. The distinction between the brokerage definition are comparatively eternal and only matter for the companies that lie on its edges. The categorization is significant for marginal companies because mutual funds use these definitions to decide what stocks to buy. The presently estimated definitions as follows. Mega cap includes a market cap of $200 billion or more. Big cap includes $10 billion or more. Mid cap, $2 billion to $10 billion. Small cap includes $300 million to $2 billion. Micro cap includes $50 million to $300 million. And nano cap, under $50 million. These classifications are growth time along with the market indications, and it is essential to observe that these definitions are flexible and not certain. For instance, in various circles, stocks with market caps of over 100 billion will be known as mega caps. In the beginning of 1980s, a big cap stock has a market cap of $1 billion. Currently, that size is regarded as small. It is endured, being seen if the definition are also slow when the market cap does. Shifting numbers. Big cap stock companies attract more of the Wall Street attention because they will have more for you to discover. The probability investments making business. Large cap stocks make a majority of the share in the equity market in the United States, which is why they make up the core of most investor shareholders' portfolios. Mega cap stocks, on the other hand, are prone to fluctuating numbers. There were 17 of these stocks existent in 2007, but the number has been reduced to less than 5 in 2010 due to the 2008 mortgage crash and the Great Recession. In 2017 and 2018, mega cap stocks have made a revival. Huge companies such as Apple have gained notable market cap records. The total number of market cap stocks in existence are not obtainable for over 2019. But what about small caps? Keep in mind that just because they have a smaller market cap does not mean that you won't be able to get any value or profits. As a matter of case, a deal of a great value in the stock market can be discovered through a small cap stocks because they have some part of the most destructible track records available. Many of them also end up surpassing their large cap counterparts. The bottom line: big and small brands are connected to the primary stock change and indexes, which also leads to uncertainty. The big and small brands are also leads to the conduct in the primary exchange, which also leads to uncertainty. The Dow Jones Industrial Average, or DJIA, is regarded as a compromising only big cap stocks, while Nasdaq is considered to be a consulting small stock company. These conceptions were largely accurate before 1990, but since then has been altered since the bottom tech boom. The market caps of stock exchanges and indexes oscillate and overlay. Brands such as big and small are subjective and comparable and will alter over time. Big does not always imply less risk, but the big caps stocks are the most likely to be stuck by the Wall Street analysis. This consideration, anyways, normally implies that there are no value in place in the big cap domain. That is all we have for today's video. If you guys enjoyed today's video or have something to say about small cap and big cap stocks, don't forget to hit that like button and share the video. Thanks for watching.